Hey guys, this is the market update. In this video, the latest data on if this rally for Bitcoin is real or just a bear market rally that will be destroyed in the coming weeks. In this video, I'm going to look at this recession data that's extremely important for where Bitcoin goes. But even more important is this data, which is the 2-year Treasury yield. And we're going to be looking at that in comparison to what the Fed says and how it predicts what the Fed is going to do. This is important if you are looking to trade Bitcoin right now. So we'll go over that. Before we get into the video, $4,000 deposit bonus on Bybit. Check that link in the description if you are a trader. Just make a deposit and get the bonus when you trade. Link in the description for that. So we're going to look firstly at the Bitcoin price and the bullish divergence that we had, which I covered in a previous video. As we can see here, the price over the last 6 months or so, just in this downtrend. However, you can see via the RSI, we actually had a bullish divergence here where the RSI was making higher lows. And so when you get that, that is often what's known as a bullish divergence, and you may be looking for a bullish breakout. This is a technical analysis which has, some importance. What's more important though for me is this time period right here, which was the FTX disaster. This is extremely important, and I'll show you why from looking at the 2-year and why I think this rally is not just some bear market rally, but it's actually taking us back to where probably the price should be pricing in current market conditions. So what I want to look at first is the government Treasury. This is the US Treasury 2-year yield. Now, as you can see, the blue line is the Treasury 2-year yield. The orange line is the Fed funds rate, the upper bound of the Fed funds rate, where they set the interest rate. Now, as you can see from previous cycle, what the 2-year does is predict what the Fed does before they do it. So as you can see, as the Fed raises the funds rate and they raise interest rates, the 2-year is much more aggressively pricing that in. The market always tries to price things in as soon as possible in the future. And so as you can see, the 2-year rate raises much higher, faster than the Fed. And as you can see, it peaks before the Fed peaks. Now, look what we've seen in this exact cycle here. By the way, this blue line is something I drew 6 months ago as the potential peak in 2-year rates. I'm going to call that one as a good call, even though it did kind of break a little bit for a while. But as we can see, the 2-year Treasury has peaked, just like it did here. And the Fed are going to raise 25 basis points at the next meeting. That's confirmed. They've leaked that, right? So another 25 basis points move. Let's call it up to here. But the 2-year Treasury is already on the downtrend. Why? Because they know what's coming. They're pricing in the future, right? And so as you can see, the 2-year Treasury comes down, even though the Fed is still paused here. The 2-year Treasury predicts the Fed is going to cut, and as you can see, that's what happens later on from the Fed. So what the Fed say is not really that important. The 2-year is telling us, the 2-year Treasury is telling us the Fed's done. Economic conditions are weakening, CPI is coming down, core inflation is coming down, employment's ticking up, and so it's just not going to stay this high. And so this coming down is essentially predicting the end of rate hikes and the eventual cut. Now, when that cut comes, that is up to interpretation. The Fed are going to decide that. It's going to be essentially as soon as unemployment ticks up to a level where they get very, very concerned that that's the end, right? That's the real end, and they'll start cutting again. We won't talk about that in this video, but as you can see, the 2-year is not wrong, and they predict that the Fed has essentially, done at this point. And so why that's important is what you can see, the FTX disaster right here around the first week of November. If we go back to the 2-year, the 2-year peaked around the first week of November. You can see that at the bottom of the screen. The first week of November, the 2-year peaked. As the yield comes down, market conditions become a little bit softer. So market conditions had basically peaked. Hawkishness had peaked at this level, and market conditions are getting a little bit softer, but no one told crypto. No one gave the memo to the crypto industry, which was reeling from this specific event. And so you had this major dump, and you had these new lows coming in. And no one was paying attention to what was happening in the macro, which was a slightly easier environment. And so this kind of bamboozled a lot of traders to think, wow, we're going much lower, we're making lower lows and we're going lower. But if people were disregarding the FTX thing and looking at macro became easier during this time, right? And so it makes sense that after FTX and that specific event is kind of done and the capitulation from that is done, what Bitcoin is pricing in here is an easier environment than it actually was even here, right? So during this price right here around 20,000, the environment was much tougher than it is now. And so yes, as Bitcoin, in my opinion, is really more like a bond. It's like a long perpetual bond almost, right? It trades along with rates and bonds and the money supply. It doesn't trade on earnings. And so yes, we should actually be back at this level, considering all else being equal, the market conditions are a little bit softer than they were back here. I therefore think this price move is not some bear market rally or a fake out. It just is fundamentally pricing in the change in macro conditions, considering also that the FTX unwind seems to be possibly not as bad as thought, and the DCG unwind is actually much better than people thought. They can pay off their creditors. They do have to restructure, but it isn't an FTX or Celsius type event. And so that's why we get this move, and I think it's warranted. Now, the uncomfortable part is the recession. How bad is it going to be? These are leading economic indicators here from Macro Alpha. As you can see, new lows for the US. This is the LEI, Leading Economic Indicator Index. This indicator has a 100% hit rate on anticipating recessions. It's now pointing to one starting in Q2 of this year. Markets in the meantime, soft landing and la la land. He's talking, I think, more about the equities market, which has priced in a massive multiple compression, but hasn't really priced in too much of an earnings, coming way down. That's because, well, earnings haven't really done that yet. And so is there more pain to come? Well, there's definitely a recession coming. This indicator has a 100% hit rate. We've seen this coming down, PMIs coming down. Everything is showing we're in a recession, except maybe the job market, but that always comes last. The data for that always comes last. Now, if you're in stocks, this is a potential massive downside. For Bitcoin, yes, I do think there is a correlation to the stock market going down. It, of course, has a correlation to that as people become less wealthy or just feel that way. Maybe they have less money to store in BTC. However, Bitcoin also has a correlation to China, who are going through immense stimulus, massive stimulus, money printing and easing of policy over there. And so it also has a correlation to that. And so you're just evening out these things. Yes, potentially maybe a worse stock market, but the China stimulus is a massive, massive tailwind for Bitcoin as well. As we can see here from the on-chain data as well, it does look like there was a huge spike up in short-term holders who have been getting rid of coins or spending coins, as you can see here. Now, according to Glassnode, they think this might be profit-taking during the rise up. This huge spike in short-term holders spending coins, potentially spending them to sell them. I don't agree with that, because I see that the short-term holders spending coins was actually rising very fast before the recent price rise. And so what I believe this may be is a lot of capitulation from short-term sellers and a lot of coins changing hands at this level. I tend to think that this is actually good news for a potential price bottom for BTC, at least mid-term, as a lot of coins change hands at that level. Now, as we can see also, despite the recovery from historically undervalued conditions, remarkably, the volume of coins aged more than 6 months, which they say is old supply, has increased by 301K. As we can see here, the FTX specific crypto debacle essentially was a capitulation event. And that's quite good news as well for a price bottom, because capitulation events where a lot of coins change hands tend to mark price bottoms as well. So I do see a lot of fundamental and macro data that is pointing to this being some sort of midterm local bottom for the price of BTC. I think this price rise is absolutely deserved. If you are trading short term, 2 major events to watch out for, which is right here, the FOMC meeting on the 31st of January. We know it's a 25 basis points move, but the rhetoric is way more important. They're kind of done at this point. You can't stop raising rates, or at least start to stop, and then say, by the way, we're really hawkish. It's just, right, it just doesn't work. And so there's nothing else that they can say at this point apart from, we're going to go for longer than you expect. No one believes that, because as soon as unemployment starts ticking up, we know what happens. And then CPI right here, this is kind of more important, right? Because if this is high again, then not good news. So if this comes in way lower, I do believe we can start to try and break through resistance, right, at 24,800, call it maybe up to 25,000. So two important events, and that's data driven right there. If you are a trader, get the deposit bonus up to $4,000 on Bybit, link in description for that. Come and trade with me on there. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.